Don't let a charlatan take your money. Today, I'm going to give you 3 simple red flags to spot a financial vende humos before they get anywhere near your wallet. We'll also look at a troubling signal that's predicting a major market drop. This signal is called the Hindenburg Omen, and it's flashing right now, suggesting a 10 to 20% drop is possible. But what does this have to do with scammers? Everything. They thrive on your fear. So let's start with how to protect yourself. Here are 3 red flags to watch out for. First, the lifestyle salesman. These people show you the Lamborghini, the mansion, the private jet, but never the strategy. They sell you a dream, not an investment thesis. If their content is more about their lifestyle than their market analysis, run away. Second, the aggressive sales pitch. They use fear and urgency to pressure you. Phrases like, "This is your last chance to escape poverty," or "Only 10 spots left in my secret group," are designed to make you act impulsively. Real investment advice doesn't need to be sold like a timeshare. And third, the savior with the secret formula. They claim to have discovered a unique, never-before-seen method to beat the market. They position themselves as the only one who can save you from a broken system. Spoiler alert, there is no secret formula. The only secret is how they plan to get your money. The core message is simple. Be critical and careful about where you put your money and who you listen to. If you want to keep receiving clear, no-nonsense analysis to protect your portfolio, make sure you're subscribed to the channel. Now, let's talk about the fear these charlatans exploit. A rare technical signal called the Hindenburg Omen has just appeared. In simple terms, this indicator flashes when the stock market is hitting new highs, but internally it's very weak. Think of it like a building that looks shiny and new on the outside, but has serious cracks in its foundation. This happens when a few mega-cap stocks like Nvidia are hitting all-time highs, while a huge number of other stocks are simultaneously hitting 52-week lows. This is called poor market breadth, and it's not a sign of a healthy market. It's the reason I believe a 10 to 20% market correction before the end of the year is very likely. This potential weakness means that future returns in the tech sector might be much lower than what we've gotten used to. We're already seeing cracks in leaders like AMD and Microsoft, which have had significant declines recently. Speaking of tech, Tesla shareholders finally approved Elon Musk's massive compensation package. This removes a cloud of uncertainty, but it's not a magic bullet for the stock. Remember, when good news causes a stock to go nowhere or drop, it often means the market already priced that information in. I'm thinking of doing a dedicated video on this pay package because it has some fascinating details. Meanwhile, Nvidia CEO came out to deny that they are selling their cutting-edge AI chips to China. This is a critical point, as geopolitical tensions remain one of the biggest risks for the entire semiconductor industry. But not everything is about tech. Look at Monster Beverage. They just reported double-digit sales growth. The reason is interesting. Consumers are starting to see energy drinks as an affordable luxury, a cheaper alternative to a daily Starbucks coffee. This is a simple, powerful consumer trend. Contrast that with a company like Power Solutions. They make products for the AI boom, and their sales went up, but their expenses also skyrocketed, and other parts of their business are struggling badly. The result? The stock collapsed. It's a harsh reminder that simply having exposure to AI doesn't make a company a good investment. And then there's the disappointment from Take-Two Interactive. They officially delayed the launch of Grand Theft Auto 6 to the fall of 2026. The market wants that game now, and a 2-year wait is a huge blow for investors. So what's the big picture here? For me, the risk-reward in the US market is getting worse. The potential upside in many big names doesn't seem to justify the growing risk of a correction. You have to fish where there are fish. In contrast, the risk-reward in the Chinese market is starting to look much more attractive, despite the short-term pain. Speaking of China, the toy company Popmart saw its shares fall after an employee's comments on pricing caused a stir. It's a volatile situation I'm watching closely. Companies like Alibaba are also in a clear downtrend, but that's where opportunities can eventually be found. We'll talk more about that in a future video. As a quick portfolio update, our tracked position in Palantir is sitting at a 62.6% gain and ALAB at 103.9%. As always, this is just data for transparency, not a recommendation. To wrap up, stay vigilant. Remember the 3 red flags of a financial charlatan: the flashy lifestyle, the fear-based sales pitch, and the myth of the secret formula. Do your own research, trust your gut, and don't let anyone pressure you into making a bad decision, especially when the market itself is showing signs of instability. If this was helpful, please subscribe so you don't miss the next analysis. And now, I want to hear from you. Have you ever encountered one of these financial vende humos? Tell me your story in the comments below.